the precious metal space, gold has been on fire for a long time. It has been kind of, while silver traded sideways for a year, gold actually just kept moving higher. So gold has had a lot of attention. Enough momentum got into gold that people then eventually bled over into silver. A lot of times I find for major trends, gold moves first and then silver is a little delayed, but then silver will play catch up on the back end, which is what it's doing right now. And so what I think is, I think gold got the attention, it got the love, and then suddenly gold's having a pullback and a pause. But now everybody is on high alert that precious metals are a hot sector. This is Samuel Benner. This is a guy in the 1800s. He was a farmer. He lost his shirt, well, financially, and he ended up doing a lot of research and found multiple cycles that come into play. Long story short, there's three levels and layers to this. This top layer is like maximum peaks. So for example, in 1999, there was a major cycle peak plus a minor cycle peak, which we led into the tech bubble. 2007 or 2008 financial crisis was another a minor peak. And then we struggled with 2019. There was a double peak, which was COVID. There was another type of panic in the market that created a sell-off. The next cycle high is this coming year, 2026. And all the analysis that I've always shared with you, David, has been saying like something big is coming, something bad is coming. The thing is, we don't know when. The markets can drag things out much longer than you anticipate. The key is to make sure you've got a game plan. This cycle is saying we could have weakness at some point in 2026. Maybe it drags over to 2027. Maybe the markets still hold up next year with some QE. I'm not sure, but you need to be prepared because when this does happen, we could see a weakness all the way down to 2032. So that's a long ways away. It's a long time to be losing money, having businesses downturn. But this is all an opportunity when the markets do correct, 2032, or when my analysis shows that the markets are turning and things are starting to strengthen. Man, if you can survive a market crash and a reset and you have your capital and you can invest it in ways that will make you wealthier so fast than anything else, you can just move into multiple things. So that's what this cycle plays into. It's a very big analysis. It's not always accurate. It hasn't nailed everything. It's just interesting because it falls in line with the most recent cycles that we've experienced as traders and investors. And the next one happens to be starting in 18 days from now. That year starts. The ticker, the timer is going for this cycle to find a top in the coming year.
Benner's framework identifies layered cycles, large generational peaks, smaller secondary highs, and emotional panic events. History supports this rhythm. The late 1990s tech bubble aligned with overlapping cycle highs. The 2008 financial crisis followed another major timing window. More recently, the 2020 pandemic shock emerged near a projected double peak. According to this model, the next critical window forms around 2026, with vulnerability potentially extending into 2027. Importantly, cycles don't give exact dates. They give danger zones. Markets can stay elevated longer than expected, often supported by liquidity or policy intervention. That's why preparation matters more than prediction.
Yeah, well, you got to follow things on multiple time frames. I mean, we can go and look at a long-term investing chart here of the weekly chart of the S&P 500. And so if we go back to as far as this chart loads, this type of analysis tells us, when we're finding a major bear market top, when there's a new bull market starting, and it gives us these windows where these kind of colored arrows are of when to be protective of ourselves, because you just never know when one of these big resets are coming. So we'll be looking at the weekly chart, the long-term investment signal, saying, okay, are we coming into a 2007 market top? Do we have the divergences? Do we have price starting to break down? All of this stuff. And so it's hard to identify a major bear market because the reality is you don't know, for example, that this is a full-on bear market until it really has a 20+% drop, and then it finds stability, and then it breaks down from there and then goes into like the 30, 40, 50+% correction. So that's what we need to see. Like, for example, if we look at 2022, the stock market pulled back 20+%, and then it kind of went into this consolidation. Now, if this broke down and broke this low, then we would probably be starting a massive bear market, a multi-year bear market. But it ended up carving out a bottom, It ended up generating a new strong trend to the upside, and we're back into a trend. So for us to know when we're going to have to see like price break down and have a correction, and then eventually kind of break another significant low. And then from there, it can go into a big waterfall. So we're going to have to look at it from different time frames. We'll probably see the stock market sell off in a big way. And we'll probably see precious metals initially have a very big rally and move higher. And you and I have covered this before, the comparison chart of 2007. And if you take a look at the chart on the left here, the stock market was trading at all-time highs. Gold was pushing to all-time highs. It's right where we are right now in real time. Similar type of setup. Both stocks and metals rallied together for the last couple of years. What I'm looking for eventually is the stock market to break down, and the money is going to come out of the stock market and it's going to shoot and get pushed into the precious metal space. So when we see this, David, when we see stocks crash and all that money comes out of stocks and people push it into the precious metal space, where gold could rally another 15 to 20% from here, silver could rally another 50 to 60% from here. Same with platinum, same with palladium. That to me is going to be like, okay, now it is like this feels like the end. The music has stopped for the stock market. And eventually the stock market will put in some type of pause. And then when it breaks those lows, that's when we go into like a stage 4 decline and the bottom falls out and there's mass devastation for businesses and bankruptcies. And gold will pull back with that. So that's what I'm looking for, is this extreme divergence where metals shoot higher, everybody loves it, and people start moving out of gold. That to me will be like one of the last indicators saying, hey, we only have a couple months left and we could be entering a big reset and a recession in the economy, global economy.
True bear markets only become obvious in hindsight. A 10% pullback is routine. Even a 20% decline can resolve into a new uptrend, as seen in 2022. The real damage begins when markets break key lows after a failed recovery, triggering cascading liquidations. Weekly charts and long-term indicators help identify these moments, but no signal is perfect. Investors must watch for weakening momentum, failed rallies, and structural breakdowns. When multiple time frames align, price, trend, and sentiment, the risk rises sharply. Until then, markets often disguise danger with false hope and short-lived rebounds.
The precious metal space, gold has been on fire for a long time. It has been kind of, while silver traded sideways for a year, gold actually just kept moving higher. So gold has had a lot of attention. Enough momentum got into gold that people then eventually bled over into silver. A lot of times I find for major trends, gold moves first and then silver is a little delayed, but then silver will play catch up on the back end, which is what it's doing right now. And so what I think is, I think gold got the attention, it got the love, and then suddenly gold's having a pullback and a pause. But now everybody is on high alert that precious metals are a hot sector because we're seeing miners breaking out. We've got silver, platinum, and palladium. Everything is taking part, not just gold. And so I think the reason we see silver moving up is because of simply people want to make more money. Silver moves faster. They're like, okay, well, if precious metals are going higher, give me the fastest moving one you got. Silver happens to be it. Silver also happens to be a much smaller market, I think, than gold. So it doesn't take a whole lot of more money to go into that space to make it go even higher. And so silver is just getting juiced right here because money's moving into it and saying, you know what, forget slow gold right now. I'm going to go into silver. And so silver is getting the attention. And it's, today, I think you and I are speaking, it's down about 4% alone.
Yeah.
But that's typical for silver in this type of environment. We got big up days, up 4 or 5%. Other days it'll be down 3 or 5%. That's just the nature of that beast because it's a tiny market. It moves fast, but it's the favored one right now. People always gravitate to where can you get the most leverage, make the most money. Silver's always been that. That's why there's silver stackers dedicated. Like silver's going to go to 100 or $500, and that's what people are stacking for, is when the system breaks and silver goes ballistic. And so yeah, silver just becomes that play later in the stages. That to me is telling me we're getting closer to a major top in the precious metal space. I still think there's another 40, 50% or more for silver to the upside, but it's telling me now people have shifted from boring gold to be more secure. Now they're willing to put on more risk, and that's a little bit of a sign that it's starting to mature, this trade.
Historically, late cycle phases often see stocks and precious metals rise together, right before they diverge violently. In 2007, equities peaked while gold surged, pulling capital into safety trades. Today's setup looks similar. When stocks finally crack, capital doesn't disappear, it migrates. Gold may rally another 15 to 20%, while silver, platinum, and palladium could surge far more due to their smaller size and leverage. This explosive move often marks the final phase, when enthusiasm peaks and risk appetite returns, ironically, just before the broader system resets. Eventually, even metals decline as liquidity vanishes during full-scale recessions.
Okay, yeah. So silver is it's fast moving. Fast moving means increased volatility. Increased volatility means more emotional traders involved, right? So when silver's had a big run like it has had here, it's had a beautiful pop and run. It's very quick and easy for it to pull back and to shake people out. And generally what I see is there's usually a 3 to 4 day window. So you have a down day like today, a 4 or 5% down day. And that wreaks havoc and echoes through the people who are holding silver, who are potentially going to sell if it moves down too much. The people who are open to selling because they're worried, they're very short term, they're going to sell. And it usually takes about 3 to 4 days. So silver sells off. Well, there's going to be, the working class. They come home tonight. They come home, they sit down, they look at the markets because they're working all day and they're like, holy crap, silver sold off today. Well, short-term traders already got out today. Like we're talking day traders, momentum traders. But then they're going to see it at night and they're going to be like, well, on Monday, I'm getting out because it looks like it's topped. It does have a little bit of an exhaustion pattern. It ran higher this morning and is closing below yesterday's low, which is not that to me alone is saying we're probably going to see a few more days of downward price. So I think you've nailed that part, David. And then, of course, there's people on the other side of the world that eventually see this move, and then they got to take action for their first day, and then they see it, and the next day, other people get out. So there's different time frames of people, investors who are going to panic out. So I think when we see a sharp move, especially in a volatile asset, it sparks emotions, and then it takes about 3 or 4 days for that fear to finally work itself out. Usually after a big down day, there might be a little bit of a pause or bounce. And that's simply bargain hunters stepping in saying, oh yeah, it sold off way too quick. But usually that overall drip of selling pressure from all the different layers of investors from around the world will carry over and drag it down a little bit more. Your other question, David, I'm trying to think of what it was. You were talking about
gold relative to silver, well, vice versa. Silver relative to gold, whether or not silver just looks really overbought compared to gold. But I think you covered some of that already.
Yeah, and you're kind of talking about the pair trade. So I'm not a fan of hedging. I used to hedge years and years ago, and I realized hedging costs money. And then a lot of times it's really hard to time the markets. So you put a hedge on, and then you realize the asset you were holding and hoping was going to go higher. You put a hedge on to protect it. Your asset keeps going higher, and then your hedge just costs you money. So to me, I feel like a pair trade is kind of like a hedge. I'm like, and my other theory is if the precious metal space is going down, if silver is going down, gold's probably going down. If the stock market's going down, or say technology, I'm not going to pair it with another sector because I look at the precious metal space as one trade. They generally move up and down together. And same with the stock market. So I stay away from pairing, stay away from hedging. It's just an expense. You're then trying to time some move you think is happening. And I think you're better to just either ride out the volatility and not put the hedges on, or exit it and get back in once you're confirmed that it's starting another uptrend.
Silver thrives on emotion. It moves faster than gold, attracts speculators, and reacts violently to both fear and greed. When capital rotates from gold into silver, it often signals late-stage momentum chasing. Sharp 4 to 5% daily swings are normal, but they trigger panic among short-term traders. Sell-offs tend to unfold over several days as different investor groups react across time zones. Bargain hunters may step in briefly, but volatility feeds itself. Historically, when silver becomes the crowd favorite, it suggests the precious metals rally is advancing, but also growing fragile as risk tolerance increases.
If we take a look at the charts, to me, well, first of all, the trend is clearly down. A series of lower highs, lower lows. It had a fairly significant topping phase through here. Then you could argue there's another kind of topping phase through here. So no matter how you call it, it's definitely put in a top and now it's in a downtrend. To me, this looks like it is begging to break to the downside. The trend is down, so most likely sellers are still selling. They're still scared. this is pointing to lower pricing. And if we took the most conservative price target on here using a Fibonacci extension here, we can just take the power of this sell-off, the strength of this bounce, and that's telling us where we should go, which is around 67,000 per Bitcoin, which is definitely going to spark some serious panic selling because we're going to break this low over here. If we break this low, there's going to be a ton of people saying they're going to jump ship because this is a significant support level. And then you could argue in the big picture, this is a giant, maybe head and shoulders pattern. We have to zoom way out on this chart because once we break this low and come down into here, it's going to have some big bounce. It naturally does. And then we're going to have this potentially neckline, which breaks down and, we could see much lower Bitcoin pricing. Right now, just though, to keep it really simple, if you want to get an idea of what to expect over the next month, I would say this move right here is very similar to this move right here or this move. And, if we zoom in on this chart, we had Bitcoin, which I think IBIT actually shows it better because it shows all regular trading hours. We had this huge gap to the upside, then a massive gap to the downside during regular trading hours. We had the same thing, a huge gap up and a sell-off, and then a huge gap down. And we're just kind of in this high volatility phase. I like to track regular trading hours. That's why I moved to the ETF, because regular trading hours gives us the psychology and the trades of the average investor who trades within the window of 9:30 and 4. And that's where the majority of volume is. And that's the analysis that I like to focus on because that's where the volume is. So either way, I do think this is struggling. I think we're going to see it go lower. It is still tied to the stock market to some regard. So if the stock market goes into a Santa Claus rally, then we might actually find some support and it might drift higher. But I would not be long Bitcoin here. I think Bitcoin, this is a bounce within a downtrend. It may bounce higher, but the odds are it's going to end up lower in due time. So if you do trade it to the long side, it should be a quick trade. You get in, catch a holiday bounce if it's got it in it, and then move aside and wait to see what happens from there.
Would you apply the same long-term cycles analysis to Bitcoin as you did with the stock market earlier?
Yeah, I think pretty much most things move in sync together. People are either net selling and liquidating assets because they're down so much, they're fearful, they don't know what to do. Most people don't know a lot about finance or business and commodities and stuff like that. And when they see their portfolio and their net worth just dropping month after month, they generally liquidate everything. And that's why we see selling in the stock market. People sell Bitcoin as well. It'll be stuck with the overall economic kind of flow of either people are taking on risk or they're all moving away from risk. So I don't think it's going to be that digital gold that people thought it was going to be. I think it has lost its luster for a while. It might come back and be really exciting, maybe at some point in 2026, but I would just steer clear of it right now.
Bitcoin continues to trade less like digital gold and more like a high beta risk asset. In periods of stress, investors sell what they can, not what they believe in. Charts show a clear downtrend marked by lower highs and failed recoveries. Technical projections suggest deeper downside remains possible, especially if key support levels break. While short-term holiday rallies may occur, they are likely counter-trend moves. Cycle theory suggests Bitcoin remains tied to broader risk sentiment rather than offering protection. Until markets stabilize and fear subsides, capital preservation, not speculation, remains the dominant strategy.